Today we want to talk about bootstrapping the yield curve. Remember last class we talked about how important for asset allocation and investment strategy that insurance companies on the property and casualty side need to be concerned about inflation. It's not an issue on the life insurance side, because the life insurance side, if you ignored health insurance, on the life insurance side, inflation is really not an issue. Very few life insurance products outside of healthcare are in any way impacted by inflation. Even when life insurers do annuities, they tend to do fixed annuities where if they're going to pay you an income for the rest of your life, it's not tied to inflation. So inflation is not an issue on the life insurance side, but it is a big issue on the property and casualty side. So bootstrapping the yield curve is a really strong way to actually forecast inflation and to get a good sense of what does the bond market think inflation is going to do, since it's an important input for the property and casualty product and risk. And then if we have time, we'll get into insurance regulation. We should have some time to start that at least. So I've gone to the Board of Governors. If you do H15, I'm not sure what H15 stands for, but if you type H15 in Google, this will probably be the first site that comes up. And it's a good site. You can also get historical data, and they have links to get you this historical data. But this is just the latest data on interest rates. And so the rates we need, we're going to come down here, we're going to use the 5-year and the 10-year and the 20-year. We're going to bring 3 rates in, and what we want, this first rate are treasuries, constant maturities. These are, if you were to buy one of these treasuries, this is the return you would essentially get over the remaining life of the security. Now it's true, if you've got a 5-year or a 10-year or 20-year, you'll get this return, but you also will be somewhat susceptible to changes in interest rates because you'll be getting coupons from the bond every 6 months, and you'll have to reinvest those, and you'll probably be reinvesting those at slightly different rates. However, the best estimate for what you'll make on this bond over the next 5 years or 10 years or 20 years, depending on its maturity, is the stated yield here. This is the current yield. And so the 5-year bond currently has a yield, really low yield, less than 1%, of 0.81. That's the 5-year. The 10-year has been coming up. It's more than tripled since last year when it was as low as 0.5%. So up to 1.57%, although it has been coming down the last few weeks. And in the 20-year, we got a fairly steep yield curve right now. The 20-year is at 2.16%. So we can use those rates to tell us what does the bond market think interest rates will be in the future. We also have inflation indexed bonds. And with inflation indexed bonds, we can also get an estimate of where we think inflation would be. And these bonds are so bizarre right now. The 5-year inflation-linked bond actually has a yield that's negative 1.72%. Just absolutely incredible. Now, I thought it was possible for 5-year to go negative. Now, essentially what they're saying, if you buy this 5-year bond, you're locking in a return less than inflation. Your expected return is a negative real return of negative 172. And so you won't even cover inflation, because what this bond pays you is a yield plus expected inflation. Expected inflation, we'll see, it's pretty low right now. So these bonds would have an expected real loss. You would be expected not to get all your money back after inflation. The 10-year is also negative. Now while I thought the 5-year could go negative, I never thought the 10-year could go negative, but it's gone negative a few times. Pretty amazing. Just shows you the environment that we are in. So it's at negative 0.76%. And even the 20-year is still negative. It's just absolutely amazing. Who would buy a 20-year bond when they know that they're expecting to lock in a negative yield? It's someone who expects inflation really to take off. And so while they still won't have a good yield after inflation, they'll at least keep up with inflation. So if inflation's 8, 9, 10%, they'll at least make that 10% minus 0.23%. So at least they'll be in the ballpark. But it still seems really amazing. So I thought the 10-year could never go negative. It went negative in the 2008 crisis, and now it's negative again here. I never thought, it seemed impossible for the 20-year to go negative, and here we see the 20-year is negative. So what do we do with this data, with these inputs? Make sure you have an Excel file open and do exactly what I do here. I'll try to go very, very slowly. So we have some rates. We have the nominal rates, and we have the real rates. By nominal rates, that's the 10-year constant maturity treasury. We call it nominal because that's what you're actually going to receive. The real rates, that's what the TIPS, the Treasury Inflation Linked Bonds, that's what they have as their return. That's only the real return. On top of that, they pay you inflation every year. So the real rate is the rate you get before you get inflation. The nominal includes both the real rate and inflation, but it has a fixed inflation. So nominal bonds have a real yield and a fixed inflation number in them. The real yield is the yield you get, and then on top of that you'll get inflation. So we'll put the 5-year treasury here, the 10-year treasury, and the 20-year. And if you remember the numbers we had, the nominal on the 5-year was 0.81%, on the 10-year is 1.57%, and on the 20-year was 2.16%. And on real yields, we have negative 1.72%, negative 0.76%, and negative 0.23%. So what can we do with this information? And so this is what we call the forward yield, our bootstrapping the yield curve. And what we're looking at here is, let's start with the 5 and the 10-year. Let's say we have two choices. We could buy the 5-year treasury and then buy and then reinvest that bond into another 5-year treasury in 5 years. So that would be a 10-year investment. All right, you buy this 5-year bond at 0.81%. It matures in 5 years, and in 5 years you take that maturity value and buy another 5-year bond. Or we could buy the 10-year treasury. So those are your two choices. And what we're saying is the market should price these two options to indifference. That is, an investor should be indifferent between those two decisions. They should view them as the same. So the market should say, you know, I have a choice. I can buy a 5-year treasury at 0.81%, and in 5 years I can buy another 5-year treasury. That should give me the exact same return as buying the 10-year treasury. If it doesn't, we don't think that's true, then we'll buy the one we think is too cheap, and we'll short the one we think is too expensive, and we'll come up with a good return. So if the market doesn't agree with that, then prices will change until that is the case. And you can actually execute that. Buying and shorting treasuries is not that difficult to do. You could buy a 5-year bond, and we'll talk about it. You could buy a 5-year bond and short a 10-year bond, and actually, if you're right about future interest rates, you could make a lot of money. So what does that mean? So if we buy the 5-year, in 5 years, what will we have? Well, we'll take 1 plus the 5-year rate and raise it to the 5th. So in 5 years, we would have 1.0412. All right, I'll give that to you as a formula. You can see it. So if you invested $1 today at 0.81%, you would end up with a portfolio in 5 years of 1.0412. Now I'm not using the effective rate. I'm not adjusting for the fact that it's twice a year. When I do it like this, the Bloomberg terminals, they actually have the forward curve. and the numbers will be slightly different. And I think it's because I'm not being precise. I should actually, to be more accurate, I should actually probably divide this by 2 and raise this to the 10th because the coupons are paid twice a year. That's probably a more accurate way to do this, and that's probably, I should try this and look on the Bloomberg machine, and that's probably why I get slightly different answers with Bloomberg, but that's fine. We won't make that adjustment. And then, what's the 10-year bond? In 10 years, what will it be worth? Well, the exact same thing. We'll take 1 plus the 10-year rate and raise it to the 10. Again, in reality, we probably should take 1 plus the 10-year rate divided by 2 and then raise it to the 20th. But we'll do this. So if we bought the 10-year bond, our expected return in 10 years, that portfolio would mature at 1.1686, ignoring the fact that we're getting coupons that we have to reinvest. So it'd be slightly different than that, but this should be pretty close to our ending portfolio. If we took those coupons and reinvested them and kept putting them back in the portfolio, we would probably end up with the bond portfolio worth about 1.1686. So what does this imply the 5-year rate will be in 5 years? Let me move these over so I have a little bit more room. Well, so what we're saying is in 5 years you'll have $1.0412, and you're going to buy another 5-year treasury there for 5 years. And the bond market's saying is when you take this money in 5 years and buy a 5-year treasury, you should end up with the exact same return than if you had just bought the 10-year. So what does that mean? Well, I'm going to do the math and then we'll see it here. We're going to take the 10-year value divided by the 5-year value and raise that to the 1 divided by 10 minus 5, or the 1/5 minus 1. And that gives us a rate of 2.34. This is actually the forward 5-year treasury yield in 5 years. So that's what we actually think the 5-year treasury will be in 5 years. Why is that? Well, because take this amount right here, this 1.04. Let's say we reinvested that for 5 years. You take that times 1 plus this forward rate and raise it to the 5. What do you think you're going to get? Well, you're going to get the exact same answer we would have gotten if we got into 10 years. So what we're saying is, if you invest your money for 5 years at 0.81%, take that maturity value and invest it for another 5 years at 2.34%, you will end up with the same ending portfolio than if you invested in a 10-year bond. Now, what is the bond market saying? They're expecting 5-year rates to rise dramatically. They're at 0.81%, and they expect them to be 2.34% in 5 years. Let me give you the actual forward rate formula. How do you do it? So here's the full formula. I'll put this formula over to the side so you can see it. But I'm going to show you the bigger formula. So the actual formula is you take 1 plus the longer period of time and you raise that to its period. So 1 plus the 10-year rate, raise it to 10th. You divide that by 1 plus the shorter period, raised to its time. So 1 plus the 5-year rate, raised to the 5th. We're then going to take all of that and raise it to 1 divided by the longer period maturity minus the shorter period, 10 minus 5, and then you can subtract 1. And that gives you that forward rate of 2.34. I'll put that formula over on the side so you can see it. That's how you get the actual forward rate. Now, why did I say 10 minus 5? Why did I just say 5? Well, it gets a little confusing here. We're raising it to the 1/5. Some students say, well, we're raising it to the 1/5 because we're using a 5-year bond, but that's not the case at all. If you're comparing a 10-year to the 5-year, you're going to raise it to the longer period minus the short period. That just happens to also be 5 years. That's why I have the 20-year bond in here. All right, so let's try this again. And let's say now we have two choices. I'm going to copy this whole thing again to a new sheet. And now let's say we have 2 years. You can buy the 5-year treasury and then reinvest that into a 10-year bond in 5 years, excuse me, or wait, 15, sorry, into a 15-year bond. So you can buy a 5-year treasury today, and then you're going to reinvest it into a 15-year bond, or you can buy the 20-year treasury. So here's your 5-year bond in 5 years. That's going to be exactly the same. That doesn't change at all. And here's your 20-year bond. And what it's going to be worth in 20 years. So there we do plus 1 plus the 20 years. Raise that to the 20th. And so how do we compare those two? Well, here we don't take 10 minus 5, we take 20 minus 5. So I just want to make sure you know the reason we're raising it to 1/5 or the 1/15th is not because we're in a 5-year bond, but it's a difference in the two. So if we're comparing the 10 to the 5-year, you're going to raise it to the 1/5. If we're comparing the 20 to the 5-year, we raise it to the 1/15th. So what does that mean? In 5 years, we're going to take the maturity value here. We're going to reinvest it at 1 plus this forward rate, raise it to 15th, and there's our 1.5333. So how do we actually adjust that here? We can take 1, well, let me do the whole formula so you can see it. Give yourself some extra parentheses here. So 1 plus the 20-year, raise it to 20th, divided by 1 plus the 5 years, raise it to 5. Take that whole thing and raise it to 1 divided by 20 minus 5 minus 1, and you get your 2.61%. So what is the bond market telling us? We don't have the 15-year bond in here, so it's probably around 2%, somewhere between the 10-year and 20. So the 15-year bond, somewhere around 2%, but the market thinks it's going to rise to about 2.61%. All right, so we've got 2 examples there. You can freeze the picture. You've got the formulas. Just put your numbers in the exact same cells I have mine in, and you build a copy. Same thing over on the 5 versus the 10. Now, what are we going to do with the tips? Well, let's do the exact same thing with the tips that we did with the nominals. The 5-year tip in 5 years, the 10-year tip. Now here we're just looking at the real return. But everything else is exactly the same. The formulas are exactly the same. So we take 1, even though we're going to get numbers less than 1 plus the 5-year, raise it to the 5th. And then the same thing with the 10-year tip. We take 1 plus the 10-year tip, raise that to the 10. That gives us our value there. And then we say, okay, well, what does that imply for the forward rate? Just like we did before, we take the value after 10 years divided by the value after 5 years, raise that to 1 divided by 10 minus 5 minus 1, and you get 0.21%. So pretty amazing. The current 5-year tip is negative 1.72%, but the market thinks it's going to be positive 0.21% in 5 years. And again, the longer formula is just like the other longer formula. You do open parentheses 3 times. I recommend you do 3 open parentheses. 1 plus the 10-year, the longer period, raised it to 10, close parentheses, divided by 2 parentheses, 1 plus the 5 years, close parentheses, raised to the 5th, close parentheses. That whole thing raised, open parentheses, 1 divided by, open parentheses, 10 minus 5, close parentheses twice, minus 1, and there's your 0.21%. Just to check it, we take what we had at the end of 10 years times 1 plus that forward rate, raised to the 5th, and there's that 9.9265. Exactly matches. So what does this tell us? What expected inflation for years 6 through 10 to be? This is called break-even inflation. And all you've got to do is you take the forward nominal rate, the forward real rate. So our forward nominal rate was 2.34%. Our forward real rate was 21, so our break-even inflation, it's just the difference in those two. And that's what you're after on the question. So the market thinks inflation from years 6 through 10 is going to be 2.13%. A little bit higher than the Fed's target of 2%. Now I saw this at a conference. Brian Sack was the presenter. It was a conference on inflation. Most of the presentations were way over my head. There were a lot of economists with a bunch of math models and just terms that were jargon I'd never heard before. So I just had to do my best to keep up. But his presentation, Brian Sachs, was this presentation, how to use the yield curve to forecast inflation and future interest rates. And I started using it immediately. I thought it was really powerful. Now, one thing he said there might be a risk premium. So that was his argument. So yeah, the bond market thinks inflation will be 2.13. However, buying the nominal bonds, buying the 5-year Treasury or the 10-year Treasury, since this is nominal, those are fixed yields. You can get those yields no matter what inflation does. They have inflation risk, whereas the tips do not have inflation risk. You get actual inflation. And so his argument was a nominal rate has inflation risk. So if you buy the nominals, you're getting a yield that's also compensating you for not just expected inflation, but for unexpected inflation. The real rate, there is no inflation risk. And so there might be a risk premium. So this 234 might be overstated. It may not be what the bond market actually think rates will be in 5 years. It might be what they think rates are going to be in 5 years, plus an additional, say, 0.25% to compensate you for that inflation risk. And Brian Sack, the guy who was doing the presentation, he said that risk premium could be 25 to 50 basis points. Now, he had some argument for that. I don't remember his arguments for that. So you need to subtract either 0.25 or 0.5. I'm going to assume that inflation risk premium is somewhat comparable over time. Obviously, it could, right now it might be higher than it was a few months ago. But I really think, this is one of the numbers I encourage my finance majors to calculate on a daily basis on their job, just to see what is the bond market saying about break-even inflation. Just keep track of it day after day after day, and just see. I've seen some reports. This was true of Alan Greenspan. I think it's also true of Bryn Bernanke. And I don't know about Jeremy Powell or his predecessor, the current treasurer, Janet. But if the Fed chairman were to see this break-even inflation get up close to 3%, they would probably start increasing interest rates. If the bond market pushes that break-even up to 3%, the Fed would say, okay, the bond market is now worried about inflation. We need to increase rates, because if the bond market's thinking about inflation is such a psychological number, once people start thinking about it, it tends to cause itself. What we call a self-fulfilling prophecy. And so right now 213 is a higher number than it's had. I wish I could actually show you historical numbers on this, but I don't have that set up. But you should try it. Get tip yields historically. You can go back to like 2003, get the nominals, and calculate this break even. And I think they do use the 10-year Treasury and the 5-year Treasury as the norm, but you can use other Treasuries. So this is what we think inflation will be years 6 through 10. Now what can you do with all of this? Well, let's take this first one, the forward rate. The bond market is telling you they think the 5-year Treasury will be 2.34% in 5 years. Let's say you say, oh, there's no way that's true. I think the 5-year Treasury won't even be 1% still. I think we're going to be in low interest rates for some time. So if you disagree, so the forward rate is 2.34%, and your estimate, let's say, is 1.25%. What could you do? Well, the 10-year is going to be the much better investment, in your opinion. Why? Because with the 10-year, you lock in 1.57% for 10 years. If you were to buy the 5-year, invest it for 5 years, you think in 5 years you'll have to turn around and reinvest that at 1.25, which is still lower than the current 10-year. So you have a choice of 5 years at 0.81% and 5 years at 1.25%, or you can lock in 10 years at 1.57. Now you may not like either one of those, but here what you could do is you could buy the 10-year and short the 5-year. And what would happen if you did that? I'm going to make a simplifying assumption here. We're going to use zero coupon bonds just to make it a lot simpler. So let's say our maturity value is $10,000. So we want some bonds that are going to mature at $10,000. So how much would you pay? So it's zero coupons. So you're going to pay a price today for a bond that in 10 years is going to give you exactly $10,000. So you take $10,000 divided by 1 plus the 10-year rate, raise it to 10. So that bond's going to cost you $85.57. And then you have the 5-year bond, and it's going to mature in 5 years. And so you take $10,000 divided by 1 plus the 5-year rate, raise it to 5th. But you're actually going to sell that. So you're going to short the 5-year. So initially you'll start off with an extra, well, you'll start off, your investment will be negative. You actually receive $1,000. All right, so you receive $1,000. And what happens in 5 years? Well, in 5 years, the 10-year bond the 5-year bond is going to be worth $10,000. That's what you bought it. What's the 10-year bond going to be worth? Well, here we got a $10,000 bond divided by, let's say the market's right, and interest rates are actually 234. Raise it to 5. So what is that 10-year bond going to be worth in 5 years from now? So you know the 5-year bond is going to be worth $10,000. That's just the nature. But the 5-year bond, well, your 10-year bond in 5 years it's going to depend. So you know it's going to mature at $10,000, and the current yield is 1.234. Raise that to the 5th power. So here you're going to be out $10,000, but you have a bond that's worth $89.10. So here, if you were to sell this bond, what would be your investment? Essentially the two, I mean, it looks like it's hard to see the math, but you're essentially going to make the exact rate you would have made. I mean, it's hard to say the math because you have 5 years left. but it would have cost you, I mean, you would have made 1,047, it would have come in, but then you would have had to pay 1,090 in 5 years for these two transactions. That's if the bond market were correct. So I can't prove to you that you're really indifferent between these two, given what the current break-even rate is, all that. So you're essentially coming out okay. You get 1,047 in this transaction. It's going to cost you 1,090 in 5 years. Essentially, you're going to make the risk-free rate doing that. But let's say the market's wrong, and let's say instead of the 5-year and it being at 234, let's say it's only at 125. Well, then it's only going to cost you 602. Well, that would be a great investment, right? You receive 1,047 today, but in 5 years you only have to pay out 602. That's like borrowing money at negative interest rates. We're almost back to Warren Buffett in the first paper, where he saw selling auto insurance as a cheap way to borrow money. Well, if you're right, then essentially you get 1,047 today, and you only have to pay back 602 in the future. Now, let's say you think in 5 years, you think the 5-year rate's going to be much higher in 5 years. Let's think you say it's going to be 4.5%. Well, if you do that, then you should short the 10-year and buy the 5-year. And if you do that, it will cost you 1,047 today, but it matures, you'll make 1975. And so, it just depends on if you think they're exactly the same, you'll come up with an investment that essentially is going to give you the risk-free rate. Whether you buy the 10-year and short the 5-year, or short the 10-year and buy the or buy the 10-year, short the 5-year, whichever you do, you'll come out with a risk-free return. But if you think the 5-year is going to be much lower, then you'll end up with a really good investment. You'll receive more cash today than you'll have to pay out in the future. So it's like a negative interest rate debt. What about break-even inflation? Well, if you think inflation is going to be much higher than this, then you would buy the tip and sell the nominal. If you think interest rates are going to be much lower than that, then you would buy the nominal and short the tip. And if you're right and inflation is much lower, you would come up with a really good return. So you don't have to do this part on the exam up here. I just want to show you, and it's easier to do it with zero coupons. So if you buy the 10-year and you short the 5-year, and at maturity you have to pay the $10,000 on the 5-year, but you sell the 10-year, then you have a really good investment if you think the 5-year rate will be much lower than it is today. Let's look at the 20-year and do the exact same type of analysis there. So let's do all of this again. I'm going to copy from the other page just to save me some time. So let's look at the tip. Just get some practice here. So what's the 5-year tip going to be worth in 5 years? So you do equal 1 plus the 5-year tip, raise the 5. Same thing we had on the other page. Here we have a 20-year tip in 20 years. Seems like a really horrible investment, right? Because you're actually making a negative yield. Raise that to the 20th. So what's your forward rate? You take what you'd have in 20 years, divided by what you have in 5 years, raise that to 1, divided by here, it's 20 minus 5, minus 1, and you get 0.27%. We don't have the 15-year in here. It's somewhere between negative 0.2 and negative 0.76, so they expect it to go negative to positive. Or you should use the longer formula. This is what you should do in an exam. So you do equal, 3 parentheses, 1 plus the 20-year, the longer rate, raised to its time period, 20, close parentheses, divided by 2 parentheses, 1 plus the 5 years, raised through its term, close parentheses, raise that to the 1 divided by, open parentheses, 20 minus 5, close parentheses, minus 1, and there's your 0.27. That's the formula you should know. And so, what do we expect inflation to be years 6 here through 20? So we take the nominal rate, 261. We take the forward rate, 0.72. So the break even here is 2.34. Somewhat higher than what we got on the other page. We got 213 versus 234, but that again, there's probably a risk premium, and probably the longer out you go, the more inflation risk you have. So there's even more of a risk premium there. So again, if you look at the 15-year Treasury in 5 years, and maybe today it's about 2%, and it's not. It's the short end that's really looking at rates increasing a bunch. I mean, you look at that. Here's the forward 5-year rate going from 0.81% to 2.34%. That's a significant rise. The 15-year is probably around 2%, so we have a 2% yield jumping up to 261. Not as much of an increase. But again, if you really think the 15-year Treasury is only going to be about 1.5%, 2%, you could buy the 20 years, short the 5 years, and in 5-year Treasury, and in 5 years, you would end up with a pretty good return. You essentially would get more cash today, and in 5 years, you'll have to pay more to get out of the short 5-year, but the net between the two will still be less than what you got today, so you essentially be borrowing money at negative interest rates. If you're absolutely sure that's the case, if you know for sure the 5 year is going to be 1.25% in 5 years, then I would do not at $10,000, I would do $10 billion. If you did $10 billion, then you get $1 billion a day. You'd only have to pay $600 million back in the future. Or what if interest rates don't move at all? What if they stay? Then you're borrowing $1,000 and only having to pay back $395. Wow, what a great deal. So that is what we mean by break-even inflation and by the forward curves. They're really powerful tools. I like showing this to you. It's important if you're in a P&C company. Inflation's such a big deal that a lot of companies aren't aware of this. A lot of CFO areas are not aware of this forward curve. And so just knowing this, you could come into the company and say, they're talking about, wow, we really need a good inflation forecast. Maybe we could hire this firm. They sell their forecast for $3,000. You're sitting in there as a newbie and you say, well, could we just use the forward curve? And they'll all look at you like, what? Who's this newbie? What are they saying? And the way you get around this, because no one wants a know-it-all newbies. So how do you get around this? Instead of saying, yeah, I'm real smart, I know all this stuff. Instead, what you say is, yeah, in one of my college classes, we went over something I thought was interesting that might be useful here. Try to get the attention off of yourself and still get the idea in. If you do that, you won't get the newbie negative. People don't like newbies that are know-it-alls, so make it as much someone else's idea that you're stealing, that you're using. That's the way to get around it. How do I know CFO areas did not know this? Well, I remember one day at UTSA, I was sitting in my office, minding my own business. The phone rings. I don't recognize the number. I pick it up. It's a conference room. It's the CEO of UTSA who knew how to do the forward curve, or at least he kind of knew. And he said, I'm in a room with all these people from CFO, and none of them know how to do the forward curve. Ron, can you show them how to do it? And I'd taken the CFA exam. I knew how to use the forward curve. It was pretty straightforward. So I said, yeah, I can show them. We can do that. But a room full of 40 people, none of them knew out of the CFO area. I'm sure glad I knew. I probably would have lied if I didn't, would have been Googling it right away. But fortunately, I knew it. Now you know it. So you know something that out of a group of 40 CFO members, none of them know it. So you're going to know something a lot of people still do not know to this day. It's very powerful. UTSA was spending several $1,000s on a forecast. I looked at that forecast. It was nothing more than these forward rates. And I said, why are we spending thousands of dollars to do simple math? So, all right, so what I want to do here is show you an actual problem from an exam. We've We got the 5-year, we got the 10-year, we got the nominals, we got the real. The 5-year is 1.62%. The 10-year is 1.78%. Boy, the time I did this problem, boy, interest rates were a whole lot different. The tips are 0.12%. They were actually positive 0.17%. We'll have to think back to when this exam, April of 2020, right in the middle of COVID. It's hard to believe real yields are actually positive not that long ago. So that's pretty amazing. So there's our yields. So what do we do? So the first thing we do is we do the forward rate. Remember, for the forward rate, 3 parentheses, 1 plus the 10-year, raised to the 10, close parentheses, divided by 2 parentheses, 1 plus the 5-year, close parentheses, raised to the 5th, close parentheses, all that raised to 2 parentheses, 1 parenthesis, 1 divided by open parentheses 10 minus 5 minus 1. So again, I'm using the 10 minus 5 just in case I give you a 20-year bond and a 5-year bond. You know that you're not raising it to the 5th power, 1/5 power because it's a 5-year treasury. You're raising it because you're looking at a 10 versus a 5. So I always want you thinking 10 minus 5. So there's your forward rate. So I did something wrong, so let's figure out where we... Yeah, I could tell it was wrong. So to the 10th, it's a typo, 1.94. How did I know that was wrong? Because you can kind of tell. Remember, if you could buy the 5-year for 162, or you could buy the 10-year for 178. The 5 years should be indifferent if you invest for 162 for 5 years and then another rate for 5 years. Well, obviously, that second 5-year period must be higher than the 10-year, but it won't be radically so. So if you can invest for 162 for 5 years and 194 for 5 years, that should give you a 10-year return of 178. So you can kind of, you can logically see that could not be 5%. Is what I got the first time. So I'm kind of glad I had a typo. So, you look at it again, I got 5.23%. There's no way that's correct. So obviously I had a typo. I look and see I accidentally typed 9 instead of 0. And so there's my return. And let's do the forward real. This is the forward nominal rate. Exact same formula. 1, 2, 3 parentheses, 1 plus the 10-year real, raised to the 10, close parentheses, divided by 2 parentheses, 1 plus the 5-year, close parentheses, raised to the 5th, close parentheses, raised to the 1 divided by, open parentheses, 10 minus 5, minus 1. Make sure you get your parentheses right. And that gives us 0.22. That makes sense. It's the same thing. You have 12 basis points for 5 years, or you can get 17 basis points for 10 years, or you do 5 years at 12, another 5 years at 22, you'll end up with the 17. So what is my break-even inflation? You can see back at the time I did this exam, because I usually use the exact rates at the time of the exam, then the break-even inflation much lower. Back then, inflation was expected. So you can see inflation assumptions have come up quite dramatically. We went from, 213 to from 172 to 213. That's why I say that number is a really good one to calculate every single day. And that would be the answer, because you look at the question, using the following treasury and tip yield. I don't know what this is, November 29. Yeah, I don't know why I'm using, this must be an exam from a couple of years ago. I don't know, it's kind of strange. Maybe I went back that far because I didn't want to use negative rates, but be aware I might use negative rates. Get the forward yield. That's that number right there, 1.95. And the break-even inflation number, that's that 172. I don't actually ask you for the forward real, but just know what I'm asking for, look for it here. So the 5-year forward yield, that's that 1.94. That's what we think the 5-year treasury yield will be in 5 years. And the 5-year break-even inflation rate, At 172, that's what the bond market thinks inflation will be years 6 through 10. All right, so that brings us to our last topic here. We've already covered this some, and so I think, we should just quickly review what we saw before. In that article, we did an article insurance regulation on premiums. And we said, just real quickly, just to bring in the idea of regulation and its impact. So auto insurance premiums at the time the article we looked at were rising more than inflation. And so the question was asked, does rate regulation help or hurt? Rates are lower in regulated states, but in those states, insurers are probably not making adequate returns. So what does it cause? It causes market disruption. It causes companies to cut back on services. So where could this come from? Well, remember, this is so important when we get to regulation. So just to bring a memory of this, we saw this when we're talking about using credit scores for insurance pricing. We saw it in this article. Rates cannot be excessive, so they need to be affordable. They can't be inadequate, so we don't want insurance companies going insolvent. They can't be discriminatory. That was a big part of the use of credit scores. And they can't be, not available. So we have to have availability. So availability and affordability are obviously closely tied to each other, although insurance industry argues if rates are excessive because the risks are really high, then we simply will stop writing in that market, and then insurance won't be available. Let us charge the right rate, and then someone in that market that's a really expensive market but has good credit scores, they'll find affordable insurance and it will be available. But if you won't let us price adequately, we'll get out of the market entirely. Now, adequate does mean they don't go insolvent, but you can also add the adequate is that insurance companies can make their cost of capital. Insurance companies need to provide a return to investors, or they'll get out of the market and the insurance stock prices will fall and the insurance market will just shrink, and then you'll end up with a bigger problem at the end. Is there a problem with antitrust? We talked about the Erfindal Index, and I even give you a link to it here. My study of the industry is it's a little more concentrated in other industries, but it's not at a level of extreme. It's still below 1,000. However, there are some markets, like Hawaii, maybe some smaller states, where there is concentration. There are only a few riders. There may be concern in those. Economies of scale. Insurance is concentrated in a few large companies, but as we said in the article, that is driven mainly for things that are good for the clients, the customer. Why? Because Geico and Progressive are getting large because they're so efficient. They're so much cheaper than the competition, so the reason they're growing so fast because the direct riders, the rates are much lower than Allstate and State Farm's, and Allstate's becoming more and more of a direct rider over time. State Farm's the one sticking with the commission sales rep. So it's getting more concentrated because consumers are getting a much better deal from Geico and Progressive. Could the problem be inefficient management, wasteful spending, wasting money? It's hard to think that publicly traded companies with stockholders and boards are just throwing parties and having fun and wasting money. Is it that they're just paying claims? And are people complaining about this? The insurance industry, I'm pretty sure, even though they may settle, someone has a fender bender with you and you think at most that was $200 and the insurance company settles for $2,000 and you think, man alive, that was a waste of money. Well, my guess is the insurance company looked at that and said, hey, if we challenge this, it's going to cost us $6,000 in court fees and lawyers. Better just to pay the $2,000 and be done with it. So, I question if there's a lot of examples of that. I hear stories all the time. However, I think the competitive nature of insurance, these are publicly traded companies. There is competition between Allstate and Geico and Progressive. I seriously doubt insurance companies are just paying claims willy-nilly. Investment income not being considered, well, now it is by law. Investment income, we talked about that float, and investment income is required by law all the way back to the 70s. Insurance companies must, when they file their rates, must consider an offset for that float. investment of float, that time value of money, that the delay between the premium and paying out claims. We talk about what is a fair profit, and here we saw that the regulators find the analysis that gives them the lowest premiums possible. So they like to use statutory data because statutory is very conservative, so it makes it look like insurance companies have are comfortable with much lower returns, but that's because it's so conservative. So regulators say, hey, you've only made a 5% return historically, why do you want more than that going forward? Well, that's based on statutory. What you really need is the market return, the capital asset pricing model like you did on exam 1. Fairness to policyholders. Should city dwellers pay more than rural drivers? I would say yes, because it's more dangerous. If you don't do that, you have the spiraling effect. We talked about that with credit scores. If you don't allow companies to charge city drivers more than rural drivers, then city drivers will buy too much insurance. Rural drivers will buy less insurance. That's going to make it even more expensive, so companies will have to increase their rates, and rural drivers will buy less, city will buy more, and you'll end up with the only people buying insurance are the city drivers, and they're going to end up paying the same that they would have paid before. So, we talked about that. That's important. The rate classes, how accurate are they? We had that big discussion on use of credit scores. You're going to cover that on exam 2. So it's good to bring this back because this all relates. It's a good reason why we have the credit score discussion on exam 2, because it's closely related to this regulatory side. So there are some consumer groups that think insurance companies are overly picky about age, gender, location, and then use credit scores to say, well, young people have bad credit scores, they tend to live in riskier neighborhoods, and they're young. There's 3 things you're dinging them on. That's not fair. The insurance company says, no, we're actually putting these together in a multicollinear model, so we're not double counting. A person who has bad credit scores in a risky area and is young is far riskier than someone who has good credit scores who's young that lives in a risky city. And the model actually makes that adjustment, but that's the debate we have. There are solvency concerns. If insurance industry does not allow, if the regulators do not allow insurance companies to charge appropriately, you're going to have major insolvencies, especially in homeowners insurance, where that's a big, big issue. And then you have these guarantee associations that tend to shift the risk to taxpayers. Really, ultimately, we talked about that earlier, there are guarantee associations. They do charge insurance companies, but the insurance companies, when they're charged to make up for an insolvent competitor or peer, they get to pay less in taxes, and so essentially it's the taxpayers who take that. So insolvency is a cost, and I probably should have indented this as part of the solvency concern. Ultimately, the solvency concerns, if the regulators do not let insurance companies charge adequate rates, that solvency issue is going to come back onto the stockholders. Onto the taxpayers, back onto the taxpayers. So that was that article. So what I want to do, really, really important for regulation, I don't know if it'll take our entire next video, but we'll have one last video. It is very, very important that you have an understanding of the history of insurance regulation. This is something everybody in the industry knows, so it's just one of the things you need to know about Paul v. Virginia, the NEIC, the Medicare and Ferguson Act. It really sets up the stage of how the insurance industry is regulated. If we have a little time, I'll get in a little bit into the legal aspects of insurance, because there's a few interesting things there that you can bring back from your law class. But next class, we'll finish up with this. We just have a couple of topics here. There's one last topic called dynamic financial analysis. Maybe at the very, very end of the next video, I'll just show you in 5 minutes what that means. That used to be a really huge issue. It's still there in insurance. It's just not talked about as an issue as much, but it's good to know about it if you interview with a job in the industry.